So let's now dive more deeply into the classic notions of market structure. How do we use it? In general, what is the essence of understanding market structure? That is, something in market formation should tell us where the price is moving, either up or down. This can be done with the help of the classical rig structure. So it looks like this. This is its simplified format. So we have a low base and a high top. So that you are not confused now, there is a higher vertex, a higher base. Everything can be done in a much simpler way. And consider it simply as a base and a top. That is, the movement goes to the base. Time passes under the base to the top. We have again this base and a new top, then a new base and a top. Base, top. And that is, the market moves like this. So it looks like this. There are absolutely different theories. There is wave analysis. You can use it in absolutely different ways. We just use this as a reference point. And now I just need you to understand the essence, because we will apply this essence on different time frames. It will be repeated, duplicated, and we will use only a small part of it to find better entry points. This structure itself, what I've marked out, is more necessary for beginners, so that they understand and their eyes run to certain points. That is, there is the base, the top, the base, the top, the base, the top, the base, the top. And this is the point we are most interested in here. That is, in principle, these breakthroughs of the structure. That is when the previous high is broken through. That is, we had a top formed. Then there was some pullback. The pullback found some support there, and the price started to grow again. It broke through this top again. That is, this top is liquidity, and when we see such broken tops, it tells us about the upward movement. So this is a kind of a statement of fact that we just see on the chart, basically. It is extremely difficult to use this market structure for something more. That is, you will not be able to trade profitably with it. That's the only thing that I'm trading is just breaking the structure down. It just, again, gives you another slice of information and an idea of where the price is going to move. But in this one, we are all interested in a small detail directly. That is, we had an upward movement here, and then we had a downward movement, how it was determined. So there is a little bit of a pattern here. Once again, when tops are broken, we have an upward movement. When the bases are broken, we have a downward movement. And it is the moment of change of direction that is important. So here, we had an upward movement. All the bases remained intact. None of these movements broke through the bases until this moment. So this base, this impulsive movement, it broke through this base. I mean, how do I label it? Some people call it a chotch, a change of character. You can call it boss, you can call it break of structure, you can call it market shift, you can call it displacement. It doesn't matter what it's called, it's the essence that counts. At some point, there is a change of direction, a potential shift. But in order to do this, we need to identify the important points, which are really, if they break through, it can signal to us that we have changed the direction of movement. And everything that happens further is just a blunt breakthrough of the constant base. That is, in fact, with these straight lines, I mark just the base, which was eventually broken. And all that we have started after this change of structure is the upward movement. This is the whole combination of elements. Yes, the breakdown of the rising structure, then the base, this downward movement, then the change of structure. It is all duplicated and repeated on all time frames. So it is absolutely repeated on everything. Again, it is important not to use this element in isolation because it is super simple, super elementary. You can figure out in half an hour where the bases are. Yes, there will be some controversial points that you can misinterpret. But the essence of this approach, it is very primitive. But what we will use further to build a proper understanding is the change of structure. That is, I do not draw these letters, I see it all intuitively. I do not draw lines either, I just observe other factors. And when I look at the market, I realize, we have a breakthrough of the structure, and all this is a small layer of information, a small piece of information. Then I look at the liquidity, the day of the week, and a lot of different factors. But this element will allow you to move correctly with the market. If the structure breaks through somewhere, you need to find favorable entry points to move further. And also, among other things, how to add more detail to this whole structure. That is where to look for entry points. This is all hourly time frame, but you need to look for trades naturally on smaller time frames. If you trade intraday or scalping, that is M15, M5, maybe M1 if you know how. But the point is what? It is most profitable and safest to sell in premium and exit in discount. That is on liquidity and so on. So on, if you realize that potentially we have a downward movement starting here and we have broken through the structure here, then it is very dangerous to sell here because the price has not even reached 50%. But here the price has already entered premium, removed liquidity, and moved on. So you already have a certain understanding. That is, you look at the market structure, you look at the premium and discount, and then you add liquidity, order blocks, gap, and so on and so forth. And this whole story is repeating itself. So we had a downward movement. It is really stupid to sell here because, yes, okay, the price may go down immediately, but in most cases there will be a pullback to the premium zone. So the price has to go up. Everyone should chase it. And here it is profitable to look for entry points to sell with exit at the next liquidity withdrawal. And now you are in this format. If you move, you will be cooler than 99% of traders, because most traders, they are trying to sell here. Here the price reaches here. Here they close the deal, start buying, although it is already necessary to sell. In this logic, it is just intuitively laid down at the subconscious level to act like this out of fear and greed. And this forms a certain behavior in people. But if you start to look at these points and compare your actions, what you see on the market, with these points, premium, discount, market structure, what I just showed you in the form of consolidation, impulse, rollback, reversal. If you combine all this with liquidity, with gaps, with manipulations, with the day of the week, and so on and so forth, it gives you an understanding of what is happening. Every time add here is such a bite information, look more adequate to market. That is, someone uses their only line trend, either their level or their 2 instruments, 3 instruments. The more tools you have, the more angles and viewpoints you can produce, and accordingly you will have a more complete picture. But there are certain rules that should be adhered to. That's it is coolest to sell at a premium, to exit at a discount. Again, subject to the condition that you will be the movement, understand what price move, what reason, and so on, so on, so on. But this small nuance makes this primitive market structure more tradable, and you can find entry points here. Here you can find entry points without fear that you will be taken out by the stop. That is, there the probability that you will be taken out is very low, and there the probability that the movement will be impulsive is very high. So it is profitable to enter in these zones, especially when we have a downward movement. So the opposite story, when we have an upward movement, that is, you buy in the discount zone and go to liquidity or some next levels. Now friends, let's go into more detail about what order flow is and how to work with it. For clarity, a little bit ahead of time, so that you just do not think that what I am about to show you is just a random set of elements that can be viewed only on history. I just want you to realize that there is some basis and context to what I'm about to show you. That is, if you do not know how order blocks work, or how gaps work, or how liquidity works, and how to combine all this, you should definitely watch the video on my channel. Everything will be described in more detail there. But I will tell you in the next video how to assemble a fully prepared hypothesis into a complete context and find entry points based on it. Now you see a 4-hour time frame in front of you. We had such a story at a certain moment. That is, there was a gap. And on this gap, the price found support. That is what I said. If we expect any upward movement, we need the price to support this logic here. The price supported this logic. And I immediately look at the next movement, or rather what liquidity can be. and immediately marking this floor of liquidity. This is basically how this movement happened. Now let's move to a smaller time frame. This is how this story looks like on M15, i.e., this movement finds support here, starts to grow. Here it breaks through the structure. Here it breaks through the structure. Well, these 2 points are already suitable for us as a variant of the fact that the price may have potentially changed the direction of movement. We never know for sure. We never know anything for sure in the market, but we just form a hypothesis. That is, I confirm that yes, there is a gap at 4 o'clock, there is a breakdown of the structure right here, and there is a liquidity target. That is, everything adds up and suggests that there could potentially be an upward movement. Here we have another gap, which also gives support, i.e., there was liquidity withdrawal here, and in principle the price has already started to grow here. Let's say you would not enter here, and at 15 minutes you can say, well, the order block has been withdrawn. I would not have noticed this one, I would not have known, and so on and so forth. Please pay your attention to 2 small details. Pay attention to the shadows of these 2 candles, this one and this one. The next candles after them, that is a deep, long shadow of the candle, was formed at the opening of the American session, and this line right here is the middle of this shadow. Just look at the reaction that these candles gave. At the moment, you don't know if there will be any reaction here. But besides these shadows, there is a gap, and that's basically all. That is, at the opening, someone was taken out here by a stop who tried to enter here. And this is the story formed, but there is still a pool of liquidity above. Now let's see how it all looks like on M1. In fact, these are the 2 lines where the price finds support. That is, this is the first factor of the hypothesis of what we are forming. That is, again, what I'm going to show you now. You can't just jump on the chart and try to find order blocks and order flow everywhere. What I am going to show you now. There has to be some context, something to support your idea that the price has to move somewhere, so there has to be some basis. And there has to be some magnet in the form of liquidity. That is, if you look at it like this, well, in principle, it is possible to enter somewhere. But this M1 is dangerous, and so on and so forth. Now look further. Now take a closer look at this movement, which you have just seen. So the main target is liquidity above. And here we have the first touch, the middle of that shadow that I just showed you, and here we have the second touch of the other shadow that I just showed you. So these are the first 2 major points. Look at the reaction here. So there's this point. And when you go to M1, you immediately notice that there is also an order block, touched exactly at it and exactly the same candle. Let's say you'd be afraid, yes, you'd think there's a downward movement. Here we have an inverted gap, that is, the one that overlapped. And if it is not worked out, yes, that is, we assume that the price will move up, everything will say that now this gap, which logically should have overlapped and brought the price down, will now act as a support for further price movement. And when you see the price reaction, that's how it fixes behind this gap. You realize that this is an inverted gap. Here the price finds support here. Here is another gap. That is, this gap, this inverted gap, was formed in a larger gap. That is, all this tells us that there are reference points from which the price will continue to push.